Hello, my name is Lisa Meyer and I am with TrustPoint, and today I am going to go over the 401k plan for Bituminous Roadways. We're going to start with the introduction to the 401k plan. So we'll go over your plan highlights and the features and the benefits of the plan. I'll also have Brett Sibian provide an investment update as well. So he'll cover the markets and investments in general with you. At TrustPoint, we have a full menu of services, including our comprehensive retirement plan solutions. So that is obviously you're familiar with our retirement plans. We offer administration, investment management, record keeping, education. So comprehensive plan for 401k plans for businesses. We also work with trust and estate administration. We work with individuals, businesses, and family offices for investment management. And we work with foundations and nonprofits. So if you have interest in any of these other services that we offer, feel free to reach out to me and I'll be sure to connect you with the right individual that can help you. So with your 401k plan, so you're eligible to participate the first day of the month following your date of hire. So those are for your own contributions. For the company non-elective contribution, you're eligible for that after reaching age 21 and 1 year of service. You do have matching, or not matching, it's more of a vesting schedule that we should cover. And so wanted to cover that today. It's 100% vested, meaning that your contributions, your earnings, the non-elective contribution and the earnings on the non-elective contribution are 100% vested immediately, which means that those are always yours to keep. When you terminate your employment, you can take those dollars with you if you decide to roll it into another account. Distributions are available when you terminate your employment. There are in-service distributions available at age 59 and a half, at retirement, death, disability, and hardship distribution. We generally recommend that you don't take distributions before retirement because obviously that money can't grow and compound over the years if it's not in there building towards your retirement goals. And then TrustPoint is your plan trustee and Bituminous Roadways is your plan administrator. For 2020, you can contribute up to the IRS limit, which is $19,500 if you're under age 50. For those of you that are age 50 or above, you can contribute up to $26,000. And next year for 2021, those are the same limits. So know that next year, the same contribution limits will apply. Most retirement planners suggest to save 70 to 85% of your income for each year in retirement. So if you look at what your income is today, if you were planning to retire, do you have enough, for retirement? And one way to get a good idea if you're on track is if you've saved 8 to 10 times your ending salary. To replace that 85% of your income. So if you've saved 10 times your salary, then you're in good shape for retirement, most likely, depending on what your plans are in retirement, that will always, be a factor as well. So, but in general terms, 8 to 10 times your ending salary should help you get on track. Your plan allows for both pre-tax and Roth contributions. Pre-tax are the traditional way to save for your retirement. Your contributions go in before tax, it grows, and then when you take it out in retirement, you pay taxes on your contributions and your earnings then. With the Roth option, you're paying the tax today, but then the money goes in after tax. And then as long as it's in there at least 5 years and you're over 59 and a half, then your earnings come out tax-free. So then in retirement, you've already paid taxes on your contributions and your earnings will be tax-free. So it's your distributions with the Roth are not taxable. So a couple different ways to save. Just know that you can contribute to both Roth and pre-tax up to that 19,500 limit or 26,000. So you can have part of your money going into each, and you can change that anytime you want. So you're always able to change your contribution rate anytime. So who will benefit the most from a Roth account? Generally, young savers will benefit because of their long time horizon that has several years for your earnings to grow and compound over the years. So it can make a big difference. Also, those who want to leave tax-free money for beneficiaries, so they can definitely benefit. Anyone who wants more distribution options in retirement. So sometimes You may want to have a big purchase in 1 year in retirement. Maybe you want to purchase a car, and so you have more expenses that year than you normally would have. And having that money in the Roth helps you to not have a lot more taxes, obviously, in that year. And then those who are eligible to contribute to, or who are not eligible to contribute to a Roth IRA, just know that the Roth within the 401k plan, there are no income limits. So everybody can participate in the Roth option. It's important to make sure that you keep your beneficiaries up to date. So make sure that you're looking at your statements. On the last page of your statement, you'll see your beneficiaries. So just make sure you keep that up to date. And there's a form that you can complete to update that at any time if you need to. If you have outside IRAs or old 401k plans, you can roll those over into your plan here. And sometimes there's a benefit because it can be a lot less expensive within your 401k versus in an individual IRA. So just keep that in mind, that that's definitely an option. And if it's something you're interested in, feel free to reach out to me and I will be happy to help you with that. You can access your account on trustpointinc.com. When you log into our website, you're going to see on the right-hand side, there's a login option and just choose retirement plans. If you've not logged in before, you can enter in your username, which would be your full social security number. And then the last 4 digits of your social will be your password. That would be the only time that you'll use that. Then after that, it's going to prompt you right away to create a new username and password for future use. When you access your account, you're going to see right away on the first page, it'll show your account balance and your contributions. Know that if you want to change your investment mix, you can do that on the website. You can review your beneficiaries on the website. You wouldn't be changing it. And you can see what your contributions are, but you'd want to fill out a form to change your contribution rate if you decide that you want to do that. But you can check performance. You can see your contributions year to date and how you're invested, beneficiaries on that little, you can see the gear on the right-hand side of the page. And that's where you're going to have your username, your password. You can make sure your email's in there and your cell. So all of that information is available, and that's where your beneficiary information will be as well. We also have our Financial Resource Center available on our website, and this has a lot of additional information that can help you on all different topics related to really any financial needs that you have. It could be, helping older parents or saving for kids' education or saving for a house, insurance needs, estate planning. So a number of different topics available on our website. So now I'm going to pass it over to Brett, and he is going to go over a market update.
Thanks, Lisa. So just to lay the foundation here, I'm going to give a broad overview of the equity and fixed income markets, talk about kind of where we were, where we are today, and where we might be going, and some of the driving factors behind that price action. Then we have a few slides on the political side of things, kind of how that has interacted with markets historically. Have a couple slides on the coronavirus, and then to put it all together, kind of TrustPoint's opinion on everything and how we kind of relate that to asset allocation and how portfolios are constructed kind of, right now and looking out into the future. So the first chart here is a 5-year chart of the global fixed income market. So it's a representation of world bond, high quality bonds. Don't need to go through each talking point here, but want to point out kind of 2 broad stories. The first part comes in this time period. So 2017 through most of 2018, we saw global bond prices around the world flat, right? There was essentially a cap on bond prices as we see here. That was really due to the Fed's monetary policy. So they were increasing interest rates over this time period or communicating to markets that they wanted to increase interest rates. And because of the inverse relationship with yields and bond prices, as rates rise, bond prices tend to fall or stay flat. And that's exactly the environment that we experienced here. On the flip side, after that period, and really takes us to modern day here, we have seen global bond prices around the world rally significantly, right? And that's because the Federal Reserve has completely changed their monetary policy. Over this time period, they're raising rates. over here they were cutting rates or communicating to markets that they were going to cut rates, right? And that really put a bid under bond prices around the world. And we can see that numerically within asset classes, year to date and 1 year periods. Year to date, you can see US ag bonds and global ag, which is kind of the proxy for the bond market, strong returns. Treasury, intermediate treasuries, so that's kind of the high quality government bond, anywhere to that 7-10 year period, up almost 10%. Going forward, we wouldn't tend to forecast these types of returns within what's supposed to be a slow moving fixed income market, but nothing less, you can see kind of the strong returns amongst asset classes year to date and over that 1 year period. The next chart, and what more people are more familiar with, are the equity markets, right? So this is a 5-year chart of global equities. So it's a representation of world bonds. Again, don't need to go through each talking point, but backing up to 2017, we saw stocks essentially rise with no interruption. What followed was different periods of volatility, right? So in this time period, we had market volatility because the Fed was raising rates, and that tends to act as a headwind for stocks. In this period, we had some volatility with the US and China trade war that was going on. And most recently, the coronavirus pandemic, which sent global stocks down 33%, peak to trough. Technically speaking, it was the quickest entry into bear market territory investors have ever experienced. On the flip side, it was the quickest exit out of bear market territory investors have ever experienced, right? So if you've heard of this V-shaped recovery in financial media, this is kind of what they're alluding to, right? You can see the V-shaped nature of this chart. This is the stock market, right? And it's a discounting mechanism. So they're always pricing in events kind of, 6 to 12 months out into the future. So what this is telling us is that markets are pricing in a very rosy picture, right? A vaccine is going to come to market, the coronavirus pandemic will end. And that's kind of the environment the market is pricing in, right? Because the current economy is not as strong as the stock market is indicating. We have industries that are still struggling. We have millions of people unemployed. But nothing less, looking out into the future, the market is pricing in a pretty rosy picture. So that's encouraging. And year to date, we can see the returns amongst asset classes. Global equities are up about 1.7%. It is very narrowly led, specifically to an asset class. And what I mean by that is the US large cap growth category has done a lot of the heavy lifting. So stocks that are within that category are Facebook, Amazon, Netflix, Google, right? All these industries that have essentially benefited from the coronavirus lockdown, right? And the shutdowns in the economy. You can see the variations between asset classes, right? So, US large cap growth to US small cap value, huge variation, right? It's something that what we call might revert back to the mean in the future, right? Where small cap value might have its day in the sun, and US large cap growth might not perform as well. But that's yet to be seen. But that's the type of the action that you might see after these large variations in return amongst asset classes. If there's one thing I'd like you to take away from this slide, it would be that large cap over year to date and over the 1 year period has generally done better than small cap, and growth stocks have done better than value stocks. So the next couple slides have to go into what has kind of driven market returns since the March bottom. So the first one here is a chart of the S&P 500 weightings by industry. So you can see the industries that have been negatively impacted by COVID, transportation, energy, retail, and the industries that have benefited from COVID, your traditional technology stocks, software stocks, biotechnology stocks. And you can see the weightings that they make up of the S&P 500. So what this tells us is that industries that have been negatively impacted by COVID generally make up a smaller portion of the total market pie relative to the industries that have benefited from COVID. So that's one reason why, people say we're in a recession, there's millions of people unemployed, how are stocks doing so well? Well, it's because the industries that are benefiting from this environment actually make up a pretty large portion of the market. The other two reasons are fiscal stimulus and monetary stimulus. So fiscal stimulus is what federal governments do in response to recessionary environments. So the turquoise here are nations' responses to the great financial crisis in 08-09, right? And it's fiscal stimulus size as a percent of GDP. In the dark bar chart lines are the response of countries after the coronavirus pandemic. So you can see, financial crisis was a pretty, terrible time. and governments responded accordingly. And you can see the response to the coronavirus pandemic is anywhere from 2 to 6, 7 times as large as it was as the financial crisis, right? So stimulus on the fiscal side has been strong, and also stimulus on the monetary side has been strong. So that's central banks, what central banks around the world can do to help stimulate economies and help them grow back to a normal environment. We don't need to go through each of these programs, but essentially, their lending programs, their loan programs, their different stimulus programs to kind of get the economy back on track, right? So, when it comes to the markets, rebounding like they have, it's really, really due to what kind of makes up the markets and the industries that have benefited from this environment. And then the federal government's response and the central bank's response in forms of stimulus measures that have really helped the economy get back on its feet and have definitely supported asset prices like the stock market, over the last several months, and will probably continue to do so over the next several months going forward. The next couple slides have to do with the election, right? So there's no surprise that investors are worried about this election and the impact that it's going to have on equity prices, right? And that's exactly what this slide says here. 73% of institutional investors are worried about the election, how it might impact prices, which makes sense, right? There's always some type of volatility around elections, but how do markets actually respond to that? And what we find is that markets generally don't care who's president, right? So this chart goes back to 1860, and it's based on a 60-40 portfolio. So 60% stocks, 40% bonds. And what we see is the annual compound return under a Democrat president is 8.4%. The annual compound return on a Republican president is 8.2%. So there's generally no difference, right? So why is that? Well, the market is always, it's long-term in nature. It's focusing on what good is going on in the world, right? Entrepreneurials, how we're growing as an economy. They're always going to take the optimistic route over the long term. The next slide, and this is just kind of interesting. Presidential approval rating. Whenever it's into this 35 to 50% area is actually when markets have performed the best, historically speaking. Anything lower than 35%, markets don't do as well. And when there's too much optimism surrounding president, we also see markets not perform as well relative to this range, right? So that's just kind of interesting when the market likes a little bit of doubt, likes maybe investors kind of arguing with each other. They think they know which way the market's going to go, and the market proves those people wrong, right? So just an interesting slide. What have markets communicated leading up to the election? Does their price action indicate kind of who will be in the White House? So historically speaking, when stocks are rising slightly into the election, it means the incumbent party is going to win. And when stocks are declining, it means the incumbent party is going to lose. And this year was actually no different. Excluding the end of the week, week of November 2nd, the end of the week where markets kind of rebounded heavily. Markets at that point were down anywhere from about 5 to 8%, depending on what index you looked at. This is, as I'm recording this, it's the week of November 9th, and we've seen stocks rebound, quite heavily after we found out that Joe Biden had actually been, he's president-elect as of Saturday night. And he had the 270 electoral votes needed. So the market kind of told us this, what happened this time historically has happened before, and they did the exact same thing, right? On the coronavirus front, globally there's been more cases but less deaths, which is generally a good thing, right? So we've seen hospitalizations tick up a little bit, but the deaths haven't necessarily followed to the degree that the cases have risen, and that's a positive development, right? So we have therapeutics out there. We're able to detect the virus quicker. Testing has ramped up significantly. We're able to help patients who come down with the virus a lot quicker and in a lot more productive manner, right? So that's positive stuff. On the vaccine front, there's 5 kind of front runners that are in the phase 3 trials. Why that is important is because they're able to conduct studies on 30-40,000 patients instead of just 10 to 40 or 10 or 30 to 40 people in the earlier phase of trials. As of this morning, this is Monday, November 9th. This morning, Pfizer had some pretty excellent news on the vaccine front. Their vaccine is proven as of right now, based on the trials, 90% efficacy rate, which is very positive, right? So markets responded quite positively today, on that news, but it's very positive stuff, right? The scientist and the financial world is saying that there'll probably be more than one vaccine that comes to market. From each one of these companies might come up with a workable vaccine. Now going forward, what's going to be challenging is the logistics of this, right? So the mass production, getting it out to the people that need it, who needs it first, right? What demographic are we going to target first? So all those are still in the pipeline, but it was very positive news today, the most positive news markets have had in a long time, right? And the economy. So what does this all mean for your portfolios? What is Trust Point thinking in the future, about where to capitalize in certain markets? And how are our portfolios being managed given the current environment? So this is our tactical asset allocation slide. So it's based on a balanced growth profile. What that means is if we had no biases in the market, we'd be 50% stocks, 50% bonds. And what this is telling us is that we are slightly overweight equities and slightly underweight fixed income, not substantially. We're, based on the balanced growth profile, it's about 52.5% equities, 47.5% fixed income. And, some of our reasons are listed over here. So why are we underweight, fixed income? Well, to kind of put it simply, interest rates have declined, pretty quickly for a long period of time, right? And based on that inverse relationship, as rates fell, bond prices rose. So our outlook for interest rates, isn't necessarily that they're going to rise just because they've came down so much. The Federal Reserve, the federal funds rate is at 0%. They've indicated that they want to keep the federal funds rate at zero for quite some time, and the outlook for rate increases just is not in the cards. So while we don't necessarily believe rates will rise, we don't necessarily think they'll fall either, just because they've came down so far, right? So with that being said, when it comes to allocating to equities and fixed income, it's one of our reasons for being underweight the fixed income markets. Very easy monetary policies are supporting bond prices. We touched on that a little bit. On the equity side, stocks are supported by very easy monetary and fiscal policy, right? We went over those two fiscal and monetary stimulus slides. Economic growth and earnings are weak, but they're improving, right? And this was a self-induced recession with no excesses or imbalances to be worked out within the economy. Before the coronavirus, we had a strong job market, we had a strong economy, right? So when the coronavirus goes away and once we get a vaccine to market, or the economy should rebound quite strongly, right? And that's kind of what the equity markets are telling us right now, with stocks at all-time highs. So that's just kind of a broad overview of kind of what we're thinking about, tactically speaking, within profiles. The next two slides just kind of support that decision. I touched on this a little bit. So this is the 10-year treasury, just a 1-year treasury yield, 1-year history of it. This isn't the entire fixed income market, but it's tied to a good chunk of it. So, we've seen interest rates fall quite heavily, right? And we've touched on that. So, 2% all the way down to 70 basis points over a 12-month period. Bond prices have risen because of interest rates falling. And going forward, we just don't see a scenario where we're able to capitalize in certain parts of the fixed income market, right? And then on the equity side, we're actually, turning a little bit more bullish on international equities relative to U.S. equities. So this doesn't mean we go sell all of our U.S. equities and buy international equities, right? No, this is a balanced portfolio. We're always going to have different exposure to asset classes and geographic locations. But, looking out into the future, we believe international equities could outperform domestic equities. And, this is just one of the supporting slides. The green areas are when US stocks outperform international stocks, and then the red is when they underperform. You can see the cyclical nature of this, right? So, and when one outperforms the other, it tends to be for a longer period of time. So what we've seen the last decade is US stocks outperform international stocks, right? Now, we're not saying this could flip tomorrow or next week or even next month. We just believe, looking out into the future, from a risk reward standpoint, it might be a good time to increase our exposure to the international markets.
Brett, thank you for that update. We really appreciate it. If you guys do have any questions at all, feel free to reach out to me. I'm happy to help. Or you can call our retirement plan services team at 612-339-2343. Thank you so much. We hope you have a great day.